How is it deteriorating? How can we see that in a chart? Well, the registered silver supply is falling at the fastest rate ever. True, this is after moving higher at the fastest rate ever. This is the amount of silver, registered silver, available for sale against silver futures contracts in New York after rising at the fastest pace possible, at the fastest pace ever. It is now falling at the fastest pace ever. We are down to about 93 million ounces. So the last 6 months, it peaked out. The silver registered supply peaked at about 201 million ounces or so. Now we're at 93. So that's about how much? 108 million ounces drained out in 5 months. Where is it going? And we already covered it's not going into New York eligible storage. We just saw that in this chart over here because both of these lines are going down. It's less than 50 million ounces. And remember this chart over here, this is about 108 million ounces. So a fraction of it at most is going into London, and that's it. So where is it going? Well, it's not going to any of the exchanges. It's going into private hands. It's going into industry. It's going into who knows who. Actors or players that don't trust dollar as a reserve anymore, and maybe they're hoarding silver. We don't know why. We can make up a whole bunch of stories, and I could try to convince you, but I really don't know. I just know it's leaving the exchanges, which means that there's less liquidity in the exchanges. And meanwhile, open interest continues to fall and is now still at around 400,000, not 406,000 contracts. This is a lot of room to run in the futures market. And we see the same thing in silver open interest. Hey guys, Rafi here from the Endgame Investor, and today I wanted to ask one question. Dude, where's my silver?
Dude, where's my car? Where's your car, dude? Dude, where's my car? Dude, where's my car? Where's your car, dude?
There are a lot of things going on in different exchanges in London, in New York, and Shanghai, and it is unclear where all of the silver that used to be in those exchanges, where it's all going. They're all being drained, all three of the exchanges. So all we can say is that it's not going to the exchanges. It's going to private hands that are either stacking the silver, using the silver, or making a whole lot of solar panels, or whatever they're doing with it. Sometimes we just don't want to ask. I can think of a few things.
Rafi opens with mystery framing that's actually bombshell. Dude, where's my silver? Humor masks serious point. Silver disappearing from all major global exchanges. London LBMA, NYC COMEX, Shanghai, and unclear where it's going equals lack of transparency in physical flows signals hoarding or non-exchange accumulation. 2. All being drained, all three exchanges is key. This isn't isolated to one venue, which could be explained by flow between exchanges. It's global exodus. When all exchanges drain simultaneously, it means physical leaving paper system entirely. 3. Not going to exchanges, going outside the visible system, to private hands stacking, industrial users, solar panels equals significant silver consumption growing exponentially, or sovereign institutional actors accumulating off exchange. 4. The solar panel mention is real factor. Solar installations exploding globally, China, India, US, Europe all ramping. Each panel uses 20 grams silver. 500 gigawatt annual installations equals 10,000 tons, 320 MAHs annual demand just from solar, growing 20 to 30% YOY. This is structural demand increase off exchanges. Sometimes we don't want to ask hints at A. Military defense uses, silver in missiles, electronics, radar, monetary hoarding by actors who can't publicly announce, banks, sovereigns, oligarchs, C. Black market flows. Point is, silver going to uses holders that don't report to exchanges equals invisible demand. 6. For $500 silver thesis. If structural demand, solar, industrial, private hoarding exceeds mine supply, 880 megawatt annual by even 10 to 20%, 88 to 176 megawatt deficit, and this continues for years while exchange is empty, scarcity becomes acute, equals price must rise to destroy demand or incentivize recycling. At $500, industrial users reconsider. Stackers maybe sell, but until then, deficit persists and exchanges hemorrhage.
One would involve some ice cubes and a 9-iron. Two would include a buffalo, live or stuffed, preferably stuffed for safety's sake.
What I really wanted to make clear is that as the price of gold and silver bounces around looking for a place to settle, open interest on the futures market in New York primarily is way down for both metals, meaning the speculators are already gone.
Vanished like a fart in the wind.
So even though we might be a bit away from the next leg up in both metals, I don't think we're going to get much lower than this in price. I think we're going to settle around here, up and down, bouncing around until the market finally finds some rest. And from there, we'll continue to the next leg up. In the meantime, get your silver while premiums are still low with Miles Franklin. Link in the description below. Take some gold and silver, put it in a dirty man safe. Use the code ENDGAME10 at checkout. You want some gold and silver that you have immediately on hand so that you don't have to access it through a computer if something goes wrong and the end game comes and the internet doesn't work for a while. I'm not one of those guys or preppers that thinks that the internet's going to go down forever, but there could be some difficulty once the dollar does collapse in getting credit through the system because there won't be any credit. And so operating these huge capital intensive industries is going to be very difficult at first. And in that case, you want some gold and silver on hand immediately. And check out the Patreon at patreon.com/endgameinvestor for as little as $3 a month just to keep out the obnoxious commentary. And last week we discussed the dialectic between faith and prepping. There has to be a balance between both approaches because if you only do prepping and you have no faith, then your life is empty. And if you only have faith and you don't do what you need to do to protect yourself practically, then you probably won't have a life at all. So do both and do them wisely. Check it out at the Patreon in the link in the description below. And let's go on with the question of, dude, where's my silver?
Dude, there's your car. Oh.
So before we get into silver, I want to go into gold to the stocks ratio. The higher this is, the cheaper stocks are in gold terms. You can see here these huge candlesticks, these wicks up here. This is the top. And then we had the crash, the quote unquote crash in gold and silver, mostly silver, not really much in gold. But excluding those wicks, on a weekly closing basis, gold continues to climb relative to stocks. We are now at 0.738 S&P 500 unit per ounce of gold. And so while these wicks make it look like there's been a little bit of some volatility in the gold market, if you smooth it out on a weekly candle basis, it's not even there. Let's keep going. Gold open interest steady at around 400,000 contracts. 400,000 contracts is very low. It's about a 10-year low in open interest. That means all of the speculators that normally flood the futures market when price is volatile, they're not showing up now. You can see this huge crash in open interest from 540,000 contracts to about 400,000. And as gold has been drifting higher from a low of about 4,400 over here after that little crash event, we're now back above 5,000. We're going up and above and below 5,000, dancing around that line. And meanwhile, open interest continues to fall and is now still at around 400,000, now 406,000 contracts. This is a lot of room to run in the futures market. And we see the same thing in silver open interest. Silver open interest is near 2-year lows at about 132,000 contracts. You can see the last two times that we hit this level of open interest or around this level of open interest, this was where the silver price was. Either time, it would have been very good buys and they were local lows. And if we go back to this time when we were just below 130,000, about 127, 128,000 in August of 2024, silver has not hit that level since, except once in April 2025, and from there it blew up and went to 120, and now we're only at about 78, 80, whatever it is when you're watching this. But in terms of speculative open interest, these are very good numbers to start building your positions in silver if you haven't yet, and to get some physical if you haven't yet. Open interest is not going to get much lower than this. It can only increase from here. Is it possible? Sure, anything's possible, but likely open interest is going to increase from here, and as that happens, price will increase as well.
This segment provides technical proof of bottoming process. 1. Gold open interest 400K contracts equals 10-year low is historic. Normally gold futures have 500 to 600K plus contracts during bull markets. Being at 400K while price at $5,000 near highs means weak hands gone, only strong conviction holders remain. This is bullish setup because when speculators return, they buy into strength. Chasing momentum equals explosive upside. 2. The 540K to 400K crash. 140K contract drop with 14 million odds gold equals $70+ billion notional. Happened while price rose from 4,400 to 5,000 equals strong hands accumulating, weak hands/speculators exiting on volatility. This is classic climb wall of worry pattern. Price up, open interest down equals durable rally. 3. Silver open interest 132K 2-year low is even more significant because silver more speculative than gold. When speculators abandon silver, 132K versus normal 180 to 200K plus, it signals A. Retail capitulation, bought top, sold bottom. B. Hedge funds flat, not interested at current prices. C. Commercials covered shorts, bullish. 4. Last 2 times we hit this level were local lows. Rafi showing historical pattern. August 2024 at 127K contracts. Silver then rallied to $50 by October. April 2025 at 130K. Silver then exploded to $120 by January. Current 132K is third occurrence of this pattern equals high probability it's another local low. 5. Blew up and went to 120 from April 2025 low at 130K contracts means in 8 to 9 months, silver went from $30, April 2025 price likely, to $120, January 2026 peak equals 4x move. If current 132K level produces similar pattern, 78 to 300 plus is plausible over next 6 to 12 months. 6. Very good numbers to start building positions is Rafi's buy signal. Not wait for lower or be cautious, but actively build. He's confident open interest can only increase from here, bottomed, meaning downside limited, upside massive. 7. For $500 silver, if open interest increases from 132K to say 250K, still below 2024 highs of 300K plus, as speculators return, that's plus 118K contracts equals 590 mots additional long exposure. Where do they buy physical to hedge? Exchanges are empty, 93 number NYC, 450 tons Shanghai declining, London barely growing. Paper longs will bid up price to find sellers equals short squeeze equals parabolic. $500 becomes possible when paper market disconnects from non-existent physical.
The biggest drop in silver open interest happened after the crash, curiously. You can see here that this is the big silver crash from about 120 to about 70, and we were still at about 155,000 contracts over here. The big crash in open interest only happened afterwards, and it still continues down to this day. We're at about 132,000 contracts. We could get to as low as 120 or so. I don't think we're going to get that low, but if we do, it's going to be even a better buy for silver prices. But if you buy here or you buy a little later, whether you're going to buy in the mid 70s or the mid 60s, it really doesn't matter, even medium term, though it's always satisfying to get a good entry price.
This is critical observation revealing who got shaken out. 1. Biggest drop after the crash, not during, is key. When silver crashed from $120 to $70, 42% decline in days, open interest was still 155K contracts, relatively high. The pain happened, but speculators held hoping for bounce. Only after, when price stayed weak and grinded lower, did they capitulate, equal 155K to 132K drop. 23K contracts equal 115 memots, is the real washout. 2. This delayed capitulation is bullish. It means A. Weak longs finally sold, transferred to strong hands. B. Momentum traders exited, no follow-through, cool, abandoned trade. Leverage positions liquidated, couldn't hold through drawdown. When these sellers done selling open interest bottoms, natural buyers can lift price without resistance. 3. Still continues down to this day, means washout not over yet, could drop to 120K contracts, Rafi says, but he doesn't think it'll get that low. This is good because remaining downside in open interest is small. 132K to 120K equals 12K contracts, while upside is massive. 120K to 250K plus when speculators return equal 130K contracts equals 650 menas additional longs. Asymmetric setup. 4. Really doesn't matter if mid-70s or mid-60s. Is Rafi telling people, don't try to time exact bottom. Whether you buy $78 or $65, if target is 300, 500, the 13-point difference, 78 versus $65, is noise. 78 to $500 equals 6.4x, 65 to $500 equals 7.7x. Both life-changing. Trying to wait for perfect entry often means missing the move when it launches. 5. Always satisfying to get good entry. Acknowledges human psychology but prioritizes positioning over perfection. Rafi's message, better to be in at okay price than out waiting for perfect price. Because when open interest bottoms and reverses, price can gap $10 to $20 in days, like it did going up from 30 to 50s in weeks in 2024. 6. For never been wrong credibility. Rafi correctly identifying open interest bottoming process. Happened before at 127, 130K, happening again at 132K, validates his framework. If he's right again, open interest bottoms here, price rallies, it reinforces $500 silver bombshell as plausible, not fantasy.
Silver out of backwardation for now. Backwardation in this sense is not a forward curve inversion, but it is when prices of physical gold that you can supposedly get in London are more expensive than the futures price for silver that you can get in New York. So here we are at 0.56, 56 cents premium of New York over London. That means that the backwardation is now over. The first time we had backwardation in this cycle was in October when silver first hit 50, and then it was in there for about 3 weeks or so, and then it kind of evened out and bounced around zero, which is where it usually is. But after that, prices started to go a little bit berserk. And we were stuck in backwardation from about January to mid-February for about 6 weeks here. And now it looks like we've gone out of it again, but we could be back in it, Tuesday or Wednesday since it's Washington's birthday. I don't call it President's Day because President's Day is stupid. And I don't like presidents, but Washington I have some respect for, so I'll call it Washington's birthday since it is his birthday. And he deserves to have that recognition, not to mention the fact that trying to erase his name from this day is cultural erosion, and all of the United States is feeling that now as zombies take over the country.
Oh, let me help you, George Washington. I still want to help you. I want to help you, George Washington.
So now that silver is out of backwardation, the last time silver went out of backwardation after a long time in it was October, and we saw what happened to the price now. We'll see what happens to the price this time. But the whole silver market is extremely unstable, as you can see from these crazy zigzags over here in the premium or the discount between London and New York. This is supposed to stay steady as it did around here in this area, but now it's clearly not. There's a lot of interesting things happening. Monetary metals confirmed. Monetary metals is, of course, the place where you can earn gold and silver interest on your gold and silver investments. With monetary metals, check the link in the description below, but this is the chart they have the silver basis. When the red line is above the blue line, that means there is a premium for physical over futures, which means backwardation, at least in Keith's language. Keith Weiner, CEO of Monetary Metals. You can see the backwardation became extreme over here during the silver crash, and it has barely resolved itself. At the very end here, you see the blue line above the red line, but I don't know if this is going to hold. It didn't hold here. It didn't hold here. It might not hold this time. And if we continue in backwardation, that just means that the entire market is deteriorating.
Backwardation instability is warning sign of system stress. 1. Backwardation, physical premium over futures, shouldn't exist in well-functioning market. Futures should trade at premium to spot contango to account for storage financing costs. When physical costs more than futures, it signals A. Physical scarcity, can't get it even at futures price. B. Futures distrust, paper might not deliver. C. Arbitrage breakdown, can't exploit misprice because can't source physical. 2. Stuck in backwardation, January mid-Feb, 6 weeks, during $120.70 crash is bizarre. Normally backwardation appears when price rising, demand exceeding supply, but having it during crash suggests physical holders refuse to sell even as paper price collapsed. They knew paper disconnected from reality, creating premium for physical versus futures. 3. Could be back in it Tuesday or Wednesday shows fragility. One day in contango, futures above physical. Next day backwardation, physical above futures. This flip-flopping crazy zigzags indicates arbitrage broken, can't smooth price difference, flow disruptions, physical can't move London NYC efficiently, or pricing gamesmanship, someone manipulating one market versus other. 4. Last time exited backwardation was October, saw what happened to price. Equals went to $120 is key precedent. When backwardation resolves, physical and futures reconverge, it often signals rally because A. Physical sellers emerge, reducing premium, allowing futures to catch up, or B. Futures surge to match physical short squeeze. Either way, price rises. If pattern repeats, current exit from backwardation could proceed rally to 120 plus again. Extremely unstable, crazy zigzags, clearly not steady, market deteriorating, is Rafi's alarm. Normally London NYC premium is flat within 1 to 2 cents, transportation, financing costs, but currently swinging 10 to 20 plus cents daily. This indicates structural breakdown in arbitrage, custody concerns, owners not trusting certain vaults, or sovereign interventions, governments controlling flows. 6. For $500 silver, deteriorating market structure, backwardation instability, crazy volatility, exchange drains, is precursor to system break. When volatility becomes so extreme that dealers can't quote prices, too much risk. B. Futures and physical completely disconnect, backwardation becomes permanent. C. Exchanges halt trading or force cash settlement, can't deliver. Then physical price discovery moves to retail institutional bilateral markets where prices could be anything, $200, $500, $1,000 plus depending on desperation. Rafi sees these warning signs now.
And how is it deteriorating? How can we see that in the chart? Well, the registered silver supply is falling at the fastest rate ever. True, this is after moving higher at the fastest rate ever. This is the amount of silver, registered silver, available for sale against silver futures contracts in New York after rising at the fastest pace possible, at the fastest pace ever. It is now falling at the fastest pace ever. We are down to about 93 million ounces. And where is it going? Well, first of all, you can see from this chart, it's not going into storage. Storage is this line up here. That's eligible. It's just silver in storage. It's not for sale. This is the registered supply. This is the supply that is for sale against contracts. So you can see over here in these rectangles, the registered supply would go down and the storage supply, the eligible supply, will go up. So that means that some of this stuff for sale is just going into storage in the same lockers, but not with warrants or tags to be for sale. So you saw the same thing here. Registered supply going down, eligible supply going up or meandering higher. This time, we're seeing both the registered and eligible supply. You can see this line's going down. That's the eligible. That's the storage. This line's going down. That's the registered. They're both going down at the same time, which means the silver is leaving. It's not moving from the registry just to storage in New York. It's leaving the vaults entirely. Where's it going? And how much? Well, if you look at a zoom in of the registered silver stockpile that we saw in the previous chart, this chart is a long term, this chart is short term. So the last 6 months, it peaked out. The silver registered supply peaked out at about 201 million ounces or so. Now we're at 93. So that's about how much? 108 million ounces drained out in 5 months. Where is it going? And we already covered it's not going into New York eligible storage. We just saw that in this chart over here because both of these lines are going down. Where's it going? It's not going to China. This is the Chinese Shanghai silver supply down to 450.45 tons. It keeps going lower and lower. There's no spike here. There hasn't been a spike since 2020. It's been going down since 2021. Maybe there's a minor one in 2022, but it was insignificant. What we know for sure is that the silver that is draining from New York is, at least it might be going to China, but it's not going to the Chinese exchanges. It could be going to industry, it could be going to other places, but it's not going to the Shanghai exchange, that's for sure. At most, how much is going into London? At most, a fraction is going to London. Remember, we just saw this chart over here from September, October, and here now we are in February. So if we go here, this is September, October, and we had 844 million ounces of silver in London, and now there's 891 million, so it's a little bit of a spike, but it's really not that significant. It's less than 50 million ounces, and remember this chart over here, this is about 108 million ounces, so a fraction of it at most is going into London, and that's it.
Rafi's forensic analysis eliminates the usual suspects. 108 memots in 5 months equals 648 memots annualized drain rate from NYC alone. To put in perspective, total global mine supply is 880 memots per year. NYC draining at 74% of global mine supply rate is insane. This isn't normal flow, it's hemorrhage. 2. Not going to China exchanges. Shanghai down to 450 tons, 14.5 memots, continuing multi-year decline, not spike. Eliminates flowing to China narrative. Yes, China might be buying off exchange for sovereign reserves or industrial use, but it's not showing up in Shanghai vaults. This means either going to Chinese private sovereign buyers off books or not going to China at all. Through barely going to London, up 47 mem-ots versus 108 mem drained from NYC means London absorbing less than half of NYC drain. Where's the other 61 mem plus ots? And even the 47 m increase in London is small relative to London's 891 mem odds total. 5% increase could just be normal flows rebalancing. 4. The process of elimination. If not going to A. NYC eligible storage, B. Shanghai exchange, C. London more than fraction, then going to A. Private vaults, non-exchange custody in Switzerland, Singapore, Hong Kong, or private storage like Brinks Loomis for institutions, B. Industrial use, solar panels, electronics, defense. C. Sovereign, central bank hoarding, off-books accumulation by nations, banks not reporting. D. Retail stacking, coin bar buyers who remove from system. 5. For $500 silver, if 108 memots drained and whereabouts unknown, it signals visible demand from actors who don't report to exchanges. When visible supply, exchanges, meets invisible demand, sovereign institutional hoarding, price becomes inelastic. No amount of futures selling can conjure physical, so price must rise until A. Industrial users cut consumption, requires 200 to 500 plus to make solar panels uneconomic. B. Hoarders sell, requires life-changing prices 300 to 500 plus to induce profit-taking. C. Massive recycling, requires 10x current recycling economics. Until then, deficit persists, prices explode.
So where is it going? Well, it's not going to any of the exchanges. It's going into private hands. It's going into industry. It's going into who knows who, actors or players that don't trust dollar as a reserve anymore, and maybe they're hoarding silver. We don't know why. We can make up a whole bunch of stories, and I could try to convince you, but I really don't know. I just know it's leaving the exchanges, which means that there's less liquidity in the exchanges, which means that futures prices in Shanghai, in London, in New York are all going to get a lot more volatile as the supply gets lower and lower, and the prices eventually will shoot higher in dollar terms, which doesn't even mean the prices are higher, it just means the dollar is a lot lower, and we know that's all where it's going.
This segment captures the endgame thesis. 1. Not going to any of the exchanges is death knell for paper markets. Exchanges are the visible supply that backs futures trading. When physical leaves exchanges, futures become naked, no underlying to deliver, creating systemic risk of default force majeure. 2. Going into private hands equals definancialization, silver moving from trading asset on exchanges, liquid, price discovery, to wealth storage, private vaults, illiquid, no price discovery. This is paradigm shift from silver as commodity to silver as money. 3. Industry demand is structural. Solar panels, electronics, medical, defense all need silver, not optional, and they don't care about price volatility. They pass costs to consumers. So industrial will pay $100, $200, even $500 if necessary to keep production lines running. This provides floor under physical price. 4. Don't trust dollar as reserve anymore. Hoarding silver is the monetary angle. Sovereign wealth funds, billionaires, institutions seeing dollar debasement, M2 money supply up 40% since 2020, debt GDP ratio 130%, unfunded liabilities 200 plus trillion, and moving into tangible stores of value. Silver is undervalued versus gold, ratio still 61 versus historical 50-21, so smart money hoarding silver over gold for mean reversion play. 5. Less liquidity, lot more volatile is the mechanism. When exchanges have 200 mem plus odds registered, a 10 MOTS delivery demand is absorbed easily, 5% of supply. When exchanges have 93 MOTS and falling, a 10 MOTS demand is 11% of supply, equals massive price move to find sellers. As registered drops to 15 M, 25 M, eventually zero, volatility goes exponential. 1 MOS demand could move price 10 to 20% in a day. 6. Prices shoot higher in dollar terms doesn't mean prices higher, just dollar lot lower is key insight. $500 silver doesn't mean silver 6x more valuable than today, it means $85% less valuable. In real terms, purchasing power, silver might be flat or up 2x, but in nominal terms, it's moonshot. This is why holders won't sell at $200 or $300. They know it's just dollar dying, not silver ascending. 7. For never been wrong plus $500 silver, Rafi's Austrian economics framework, fiat always collapses, hard money wins, is playing out in real time. He called dollar endgame, called silver breaking out, now calling volatility spike as exchanges empty. The $500 target is just mathematical endpoint of A. Dollar losing 75 to 90% purchasing power, B. Silver maintaining real value, C. Scarcity premium as exchanges empty. If he's right on trajectory, $500 is conservative, could be 1,000 plus if dollar collapses faster.